Welcome back. If everyone could please take their seats, we'll get started.
Adam.
No, we'll reserve them.
All right, so up next, we have a panel of some very distinguished experts who's going to share trends in Miami commercial industry, commercial and hospitality real estate. To lead the discussion, I'd like to introduce our moderator, Adam Tiktin. He's the managing director of Franklin Street, and he's also a leading power broker with decades of experience. In addition to serving as managing director of Franklin Street, he's also a principal with commercial shopping centers and single-tenant net properties within his own portfolio. So he's really able to lend a comprehensive perspectives to this discussion. So Adam, welcome.
Thank you. This is terrific. That was an incredible panel, the last panel in Boom and Bust in Miami. It's incredible the experience that all of them have and the insight, and it was great hearing them. Tough act to follow, but we do have an incredible panel here. Very excited to introduce them to you in a few minutes. Wanted to start out by thanking all of you for being here and for your time. I'd like to introduce myself. My name's Adam Tiktin. I'm currently the managing director of Franklin Street Investment Services, and I specialize in investment sales of shopping centers, office buildings, single-tenant properties, and high-rise development opportunities. I'd like to also thank Dr. Ali Baraha and Dr. Bill Harden. If it wasn't for them, this event wouldn't be possible. I'd like to thank the esteemed panelists. We do have an incredible set of panelists, and I'm very excited to hear more about what they're doing and talk about some of the projects and things happening in the market. And last but not least, I'd also like to thank Jennifer Becker, who is the MC of this event, for her work on the FIU Advisory Council, for all the great work she's done for me and my business over the years, and for being one of the best people that I know. So we have a good amount of time together here today, so I wanted to take a couple minutes and introduce myself a little bit more to you and to the FIU students. I've been in real estate in some form or fashion my entire career. In this entire time, I've basically been working in a sales capacity, mostly in brokerage or an entrepreneurial capacity. I've been self-employed for 31 out of the 32 years of my career, and what that means is I'm an optimist. I'm an entrepreneur through and through.
Were you unemployed for that other year, or was it?
Actually, I was a CPA, but I don't like
Okay.
So that's the reason I became an entrepreneur. So
That'll do it to you.
yes. So I got into investment sales 21 years ago, actually 2 weeks after 9/11 to be exact. My first position in investment sales was with Marcus and Millichap, starting in the Fort Lauderdale office. Actually, one of the panelists who was in the last panel, Still Hunter, I don't know if he's still here or not, but anyway, Still is a very good friend over the years. I've known Still since he's maybe 21 years old, 22 years old, and to hear him say he sold $15 billion of real estate over the time is just mind-blowing. There was some really great people that I worked with at Marcus and Millichap back then, and through the entire 15 years I was there. I did move to the Miami office in 2008, right before the global financial crisis. It was a very interesting time, but I moved to Miami because I love Miami. Miami's home. There's also a lot more buildings to sell, and I just thought it was a much more interesting place to be. So I did leave Marcus in April 2016. I launched my own brokerage company, which was Tiktin Real Estate Investment Services. I did that for 5 years. It was a great ride. I sold it to Franklin Street in July 2021 last year at the peak of the market. I was very happy with the timing, and so it's really been great. Over that time, just some numbers. I closed about 450 commercial transactions as a broker. I've closed about 30 commercial transactions as either a general partner or on my own. 2021 was my best year ever in terms of commissions earned, and 2022 has actually been my best year ever in terms of total dollar volume sold, which is going to slow down significantly moving forward. And lastly, 2022. I've actually bought and sold more properties as a principal than I ever have before. Currently, I am in the process of getting out of brokerage and I'm going to be launching my new company in the first quarter of 2023, which is called United Capital. It's going to be focused more on private equity and asset management. Now I would like to move to the discussion at hand. We are living in very interesting times. The country is very divided on many issues. We have a lot on our minds right now. I would like to say that I do love this country. I love this city, Miami, and I also love FIU and what it represents. And I'm very excited to be here for all those reasons. Wanted to mention the title of the panel, which you do see on the screen, which is Key Trends in Miami Commercial and Hospitality Real Estate, Addressing the Needs of a Global Gateway. We have an incredible panel for you today. I'm excited to introduce them. I'll mention their names and their titles, but then I'll pass it on to each of the panelists, and I'll ask them to introduce themselves and also talk about some of the current projects that you're working on to let everybody know a little bit more about who you are and what you do. So we do have Monica Xuereb, who's sitting over here. Monica, thank you for joining us. And Monica is the Chief Revenue Officer of Loews Hotel. I will also say that we have an international panel, which is exciting because it truly represents Miami and also FIU. Monica is originally from a small island of Malta, which is between Italy and Africa, and I Googled it, and it's an incredible looking place. So welcome.
Thank you.
Next up is Rod Castan. Rod is over here. Rod is the Executive VP and Principal of Metro Commercial. Rod is a good friend. We've known each other for many years, being in the retail industry together. Rod has developed some incredible projects, just very large projects, and I'm excited to have Rod talk a little bit more about some of the projects that he's working on. So Rod, thank you for joining us. Next up is Jakub Hejl, who is the president and founder of Westside Capital. Jakub, thank you for joining us. And Jakub, I believe you mentioned you're from the Czech Republic originally, which is fantastic. I was just there personally visiting the Czech Republic and Prague. It's one of the most beautiful cities I've ever seen. I was there in May, and thank you for joining us, Jakub. We have Cassie Resnick, Managing Director of Mast Capital. Thank you for joining us, Cassie. And last but not least, we have Anthony Graziano, whose friends call him Graz. And so Graz is the CEO of Integra Realty Resources. So if everybody can help me welcome our panel, we've got a great event here for you. Thank you. So if we could, Cassie, if we could start with you, just introduce yourself and talk about some of the projects you're currently working on.
Sure. Hi, everybody. My name is Cassie Resnick, and I work for Mast Capital. I joined Mast Capital about 11 years ago in 2011 when Miami was obviously a very popular place, but a little bit of a different investment place. Since 2011, we've done a lot of work in the fund. We've started a large merchant building platform where we have about 8 to 10 multifamily developments now in the pipeline. We have 2 really marquee condo developments, both in Miami, one in Brickell, one on Miami Beach. We have 2 hotels currently in the portfolio. We just bought a large property in Wesley Chapel called Saddlebrook Resort, which has a lot of residential development. It's a large condominium hotel. We also have a nice hotel in Sunny Isles. So for the fund, I help solve problems. I help think creatively and come up with solutions and try to always maximize value. So I'll be involved in anything complicated or involving critical thinking or problem solving to try to drive value.
Hi, everybody. I'm Rod Castan. I'm a principal with Metro Commercial Real Estate and also president of Barron Collier Investment Partners. And I'm a sunblazer. Is anyone here a sunblazer? Does anyone know what a sunblazer is? There we go. So I'm a graduate of FIU. But when I was here, there's only 7 buildings in the whole campus. And we were sunblazers. We weren't Golden Panthers then. So it's great to see FIU grow up and get so prosperous and exciting with all these new buildings, these new students, and these new degrees that are offered here. And I'm a huge supporter of FIU and on the advisory board of FIU's Hejl School of Real Estate. With Metro Commercial is a 35-year-old company out of Philadelphia and New Jersey, which represents 140 retailers around the country and 8 million square feet of retail properties. and develops and partners with a number of companies, but in particular Barron Collier Company out of Naples, Florida. And with Barron Collier Company, we have a number of developments going on throughout the state. We're involved in the development of the city of Ave Maria and the commercial that'll go around Ave Maria, among other projects in Southwest Florida. And we're involved in projects in mixed use in Central Florida and in the East Coast of Florida too. Prior to joining Metro Commercial, I was 27 years with Cortellis Company, here based in Miami. We developed about 5 million square feet all around the state of Florida of retail and multifamily properties, and developed a pretty robust third-party business as well, where we represent a number of developers such as Terra Group and Grass River Properties on their developments all around Southeast Florida. So we're very active in the retail space in particular, and I've had a very robust few years here in Miami doing retail deals and seeing Miami grow as a real retail destination.
Hello, everybody. Oh, wow, sorry about that. My name is Jakub Hejl. I'm the founder and president of Westside Capital Group. We're based out of Coral Gables. I went to University of Miami, and so I can speak to how I feel about Miami being a gateway to global business. I did work in New York and London, but always knew that I was going to come back to Miami because I believed that the environment from a human talent, weather, climate, cost of life, taxes, all that was just highly accretive to starting a business in a very saturated space where costs to enter the business would be much higher in New York, London, or other gateway cities in the U.S. Now, that's 10 years ago, so obviously today we're looking at things a little differently. But nevertheless, just a quick intro. We are a real estate investment company. Westside currently has close to 8,000 units in pipeline, multifamily units throughout Southeast United States. In land we owned with entitlements that we are developing, and we own close to 4,000 cash-flowing multifamily units, either straightforward cash-flowing multifamily or mixed-use projects that have some retail and other components. Our portfolio is spread throughout the state of Florida as well as Georgia, Alabama. We're currently looking at a new acquisition in South Carolina, so we're Southeast-centric, and look forward to kind of discussing the nuances as we move forward through the panel. Thank you.
All right, well, good morning, everyone. I'm Monica Xuereb. I'm the Chief Revenue Officer at Loews Hotels & Co. I oversee sales, marketing, revenue management, catering, conference services, and analytics for the company. Just a little bit of a brief note about Loews Hotels. I think what makes us different, we are based in New York City, but I do live here in Miami. I think what makes us different than a lot of other hotel companies you may have worked with or have been familiar with is that we are an owner, we are an operator, and we are a developer of hotels. Whereas a lot of hotel companies tend to be kind of asset light or want to be asset light, we actually want to own our hotels. So we own or partially own all but 3 of our hotels. We have a long history in South Florida with the Americana that opened in Bal Harbour in 1950 or so that we don't have anymore. But we do have 26 hotels in the US and Canada. You may be familiar with our 8 hotels at Universal Orlando. The Loews Miami Beach, of course, which we built around 25 years ago. And yesterday, we opened the Loews Coral Gables. So that is our 26th hotel. We have a very strong presence in Florida and hope to continue that. Thank you.
Good morning, everybody. My name is Anthony Graziano. As Adam mentioned, people call me Graz. The genesis of that is, nobody remembers Tony or Anthony, or should I call you Tony or Anthony? So everybody remembers Graz, and I appreciate it being introduced this way. I am the CEO of Integra Realty Resources. We have 53 offices in the United States and Caribbean. We are, at our core, a market research company. We specialize in real estate, commercial real estate appraisals, market studies, feasibility studies. We also have many of our experts throughout the country do expert witness work, litigation work, right-of-way. We have basically a large diversified platform as a market research company. We don't buy, sell, broker. We have no conflicts. So I'll feel free to say whatever I want today, even if it's contrary to anybody's particular project. Other than some private investments that I do, we're independent, fully independent, and our job is to really deliver good market reconnaissance and good market information to the real estate market.
Excellent. Thank you, everybody. Graz, kind of piggybacking on what you just said about valuations and being independent, can you talk a little bit about how you're valuing properties, how you're appraising properties today? I mean, the investment sales market is, I don't want to say collapsing, but it's possibly heading in that direction as far as I could tell. How do you value properties with interest rates skyrocketing more than any of us have ever seen in our career in such a short period of time?
Very carefully. Very carefully. Look, really the last 60 to 90 days, the markets have seized. That's the reality. I think if you talk to anybody today that's been out in the market looking for financing, the banks are very much not lending at the moment, and by asset class, even more so. There's been obviously a huge disruption with all the interest rate change, and the interest rate changes and the increases have been well projected to the market since the early part of 2022. I think certainly the first jump that we took in February was sort of priced into the market. The second jump that we took in March was not, but it was expected and everybody took it. But clearly the Fed thought that these big 75 basis point swings, they thought they're going to take 2 whacks at it and then be able to evaluate things slowing down. And they don't see things slowing down. So they've taken another 2 75 basis point whacks at it, and they still don't see it slowing down. And I think the recent guidance we got this week is making people very, very nervous in the finance world. And so, one of the questions that we have broached to us through all levels of the lending arena where we do financing, appraisals for financing is, what are you doing about reflecting what's happening in the current market? And a lot of appraisers are saying, well, what's happening? Everybody's still trading. Everybody's still buying apartments on 4 caps. We don't have any data to show us that capitalization rates have gone up or that rents are going to slow. So we're at this sort of really interesting juncture where the data is not in yet to demonstrate that values are retrenching. And yet everybody knows that they should be, but we still see transactions closing at yesterday's numbers. Now, admittedly, that's the core problem in the valuation business, with only relying on this idea that you have to have evidence, sales evidence, to say this is the value. We used to say when I was younger in the business, real estate appraisal is a combination of art and science, right? And some people say it's more art than science. We've sort of gotten away from that. The proliferation of data services, everybody has data now. It used to be the appraisers were the sort of the warehouse. The brokers were too busy and making too much money to ever worry about collecting and figuring out what everything was worth. And so all of us nerds in the appraisal departments, we would be tracking all the transactions. And the brokers would call us and say, hey, what's happening in the market? The proliferation of data has gotten everybody sort of drunk on this idea that you can observe in real time what's happening in the market. And you can't. Nobody can. The reality is what we're observing is usually about 3 to 6 months delayed. And so what's happening right now is we're in this period where things have changed. There is no observation technique that shows you exactly where things have changed. There's fear and expectation and all of that. But what's interesting is nobody's saying that it hasn't changed. They're just saying, well, what's the new number? And so we're going through this period of what I'll call normalization, where we are going to see values. Values have come down. The question is just we haven't seen it in the trading data yet. And so really, as real estate appraisers, we're in this very bizarre area where we sort of know where things are today, where they should be. And then if you tell your clients that, depending on the perspective of the client, they go, what? You can't prove that. Show me where that number comes from. But more and more, the banks and I think the institutional funds and REITs and pension funds and so forth are coming to the realization that they're going to have to start benchmarking, re-benchmarking their values downward. Otherwise, they're going to wake up and have huge volatility. The banks are trying to get more conservative intentionally. Equity investors are trying to get more conservative intentionally. So the last holdout in this last 60 to 90 days, and I think it's probably still going to take another 6 months, the last holdout in the repricing is the sellers. The sellers don't have to sell right now. Most of them are not in duress. They're out in the market saying, if we can sell at this price, we will, and if we can't, then we won't sell. And that's why you're seeing almost no transactions happening right now. And that's why the investment brokers are scared, and that's why you're seeing people laid off in the mortgage company, in the mortgage business, the banking industry. You're starting to see layoffs already, because everybody knows there's going to be less activity. CBRE just announced, I think last week, they're doing a $4 billion restructure and reduction in force. So we are at a critical juncture right now as we sit here today, and it's happened and evolved over the last 60 days, and that pivot is going to happen and drag us into 2023. Not to scare anybody.
All right. Thank you. Thank you. So I just read something yesterday I thought was so interesting. It was a study by Moody's, and it was talking about negative leverage. And in the study, it said that in the third quarter of this year, that 30% of debt that was placed on new acquisitions, 30% was negative leverage, which to me, that's a very scary thought. And to me, what that says is that people had tied properties up in the first quarter, second quarter, and they got stuck, and they had to close in the third quarter, and their leverage was negative, meaning that their returns were going to be lower than their interest rates. And nobody buys a property to lose. Nobody wants to lose money. And it's also interesting because it said that in the second quarter, it was 30% in the third quarter, it was 10% negative leverage in the second quarter, and it was 5% in the first quarter. So it makes you wonder, what is it going to look like in the fourth quarter, which we're almost halfway through this quarter. So, people are deciding, do I cancel this deal if they're under contract? Do I renegotiate, which we're seeing across the board, all over the place in the last months, really, 3, 4, 5 months. Properties that are tied up, they're not penciling out anymore, so people are retrading, renegotiating, or canceling. So with that, all of you do different things. You're all investors and developers in some cases. If we can start with Monica, if you could talk about how are you looking at new deals now, and or what is your acquisition plans for the next year or two, and how are you maybe changing your strategy? And then we'll go this way to Casey.
So we, most of our capital comes from Loews Corp, which is our parent company, which we do have to compete with capital with the other subsidiaries of Loews Corp. But we're very cautious about our growth. Again, we need to make sure that if we're investing the money of the parent company, that we're doing it in projects where we're in it for the long term. We are not really into franchising or doing anything like that. So our last project that we financed during the pandemic is a hotel in Arlington, Texas, 888 rooms and 250,000 square feet of meeting space. We're basically going to run the convention center in Arlington, Texas, which is right across from Dallas Cowboys AT&T Stadium, and it's a huge, market that's really growing for us, and we already have a hotel there. But as was talked about here, that was a really difficult project to finance. So, we're very cautious about what we're doing. I think a lot of people thought there would be a lot of distressed assets to pick up during the pandemic, but that didn't really happen. And we don't really have as much visibility as to whether that's going to change, especially in 23 with a lot of, what you guys are talking about.
And I would say too, I don't see the distress in the market yet. I don't see people afraid. I think a lot of the deals that are under contract this month and going into the back end of the quarter, they're going to have to find alternate sources of money. But I agree with you. I don't see a ton of distress in the market, which is fine, but that's also the reason the sellers haven't come back to the earth.
And I think also we tend to like to build hotels from the ground up versus taking over hotels. So that kind of limits our growth in certain ways, but we're kind of okay with that.
Okay. Jacob?
Yeah, so for us, it's a very complex analysis. It's all driven by capital markets. So in Q4 2021, we were able to finance lease-up deals or highly opportunistic deals at, say, 300 over SOFR on a floating rate basis at maybe 3+1+1 structure with a debt fund or a floating rate debt provider. That market is completely gone. So any buyer who effectively was buying into an upside of a property without necessarily having the cash flow day one, but having a pro forma that was facilitating for them to get to a yield on cost in, let's say, 12, 18, 24 months, those buyers now don't have the ability to finance their projects, right? Last year, they would have gotten as high as 80% loan to value, in some cases 85, depending how you look at it, if you include CapEx and all that. And that market right now is virtually stalled. To the extent you want that type of financing, you're probably looking at anywhere from 400 to 500 over SOFR, and the delta is that SOFR was at 25 bips in Q4. It's at 3.5 to 4, depending when you look at it now with the latest hike. And so you do the math, and you are pretty much looking at 9% loan. Now, that's why nobody is really, pursuing those situations unless they have to, and the market reverted to more fundamental approach to valuation, more fundamental approach to investing. And everybody is focused on in-place cash flows. The financing options that are out there, depending on the product type, are really bank financing and life companies financing at lower leverages. So let's say 55, 60 LTV. And then in the multifamily space, you've got agencies and HUD that are still relatively competitive. So Freddie Mac, Fannie Mae, and HUD. Problem with HUD is, it takes 18 months to get a loan done. So by the time you apply for the loan and you're done with the loan, the world might be very different. So you're taking a risk there. And in terms of Freddie Mac, Fannie Mae, they're still relatively competitive, but their LTVs have come down significantly as well. And they try to fight the interest rates and the overall environment with variety of mission-driven programs. They give you bonuses to the extent your project has, what they call mission-driven components, affordability, AMI, all that. And that doesn't mean that's affordable housing, but it's, they're pushing that narrative. But overall, that's kind of the environment we see. What's interesting in our portfolio is, 24 months ago, 18 months ago, when we asked for a BOV, throughout Florida, let's say, the cap rates, the valuations would have been at 3.5 caps. I'm just making this up for the sake of a conversation, but very low in core, or I should say primary markets, Tampa, Jacksonville, Orlando, South Florida. Today, all else equal, that would probably be a 4.5 cap on a, on a BOV. The delta is that rents have grown so much that the value is actually the same or higher. Now, that's specific to Florida, Miami, Tampa, Orlando, Jacksonville. You're not necessarily seeing the same type of, velocity on the fundamentals in markets outside of Florida, right? But that's kind of an interesting thing where, yes, cap rates have expanded significantly, but values remain, similar to where they were 12, 18 months ago, despite the fact that the cap rates have expanded tremendously. And then, in terms of land values, that's a slower moving process, because generally a buyer ties up a piece of land and it takes 12, 18 months for them to close on it. And so talking about data and what's in the market, right, you got to be patient to see where that shakes out. But although, cost of financing on developing and costs in general continue going up, fundamentally, and again, this is specific to Florida, Miami, Tampa, Jacksonville, Orlando, the values remain to be relatively attractive because there's shortage of new supply of housing, mostly in our world. And so developers continue being relatively competitive still if they're bidding on a land deal. But it's hard to tell, because putting something under contract subject to contingencies is one thing, actually closing on it is another. And right around Q1, Q2, there were several examples of record-breaking deals. Like there's a parcel in Lakewood Ranch in Sarasota that the entire state talked about that was $115,000 per multifamily unit on a land basis, meaning not a building, but just developer
That's what
paying
we used to pay for the door.
Right.
Improved.
And everybody was like, oh my God, like this is, and guess what? Q2 came and 115 was all of a sudden 95. And I don't have the latest, right? But, and I don't know if it ever closed, but there were a couple kind of high flying, benchmarks in terms of pricing that obviously the market, as interest rates went up, deals were either renegotiated or they closed. But the other side of it is fundamentals continue being extremely strong. And so, Florida, I think, and in particular South Florida, is withstanding the macro changes in a very different way than maybe the rest of the country is, and more secondary, tertiary markets where it's all more cash flow driven. But, happy to kind of get more into weeds as we continue here.
You make a good point, though, and I'd like to point this out for everybody's thinking. I think, Jacob, your idea that the land deals that are now being retraded or maybe aren't going to close because they've taken longer they're not only interest rate driven, they actually started cratering a year and a half ago when construction costs were going up, right? The feasibility of being able to pencil something out as construction costs were rising, that's actually been happening for quite a bit longer. But the developers at the time were saying, well, we're going to make it up on rent growth. We're not going to be out of the ground until 2 or 3 years from now. So if we still keep getting rent growth of 5–10%, that's going to cure our problem. And by the way, the money was so cheap that sort of was offsetting the construction costs. Now it's this perfect storm of, hey, if the economy slows down, we're not going to get the rent growth, and the construction costs and supply chain are still up, and now we don't have favorable financing. And so that's where the land market is at right now. And I would suggest we're in for a ride there.
Maybe just one quick comment. I agree with that, but what was interesting is during COVID, although construction costs were going up so quickly, land values were actually going up faster, right? In other words, the residual value of those projects that people were putting in their pro forma was going up faster based on both of the things you've mentioned and the inflation and construction costs. So let's say in our Central Florida portfolio, what would be all else equal at $30,000 per buildable unit value pre-COVID got to 60, 65 post-COVID, and now we're trying to figure out, well, is it 65, is it 45, where is it, right?
Yep.
So now you're kind of, but that definitely is, something that we'll see over the next 6–12 months where, where the market kind of levels out. I would say on the rents, they're definitely flat. So that's one thing that, I think the CPI data gets wrong because it's backward looking in the indices. In terms of CPI data, 30–40% of the growth in CPI is driven by housing, but I think that's because the growth happened 6–12 months ago, and now you're marking to market based on what happened 6–12 months ago. But if you look at rents today, they're flat or they're going down. But the thing is that if I have a 12-month lease, I didn't necessarily have an opportunity to address the growth with some of the tenants that happened 9 months ago. So headline would still look like rent is growing, but if you look month to month over the last 2 or 3 months, there's no more growth. And that's an example of something where I think, the aggressive rent hikes based on the CPI data might be a little bit questionable at times because, you're looking at that data. Is it real data of today or is it data of 6–9 months ago? But that's for a
You might need
separate
to email
conversation.
Jerome Powell and let him know that.
No, I think to echo what you're saying, Jacob, and I'm glad you brought up COVID too, because I remember in 2020 we were all in that freak out mode that are our shopping centers going to become empty? Are the tenants going to stop paying? Are the apartment tenants going to stop paying? What are we going to do? And we had to roll up our sleeves and take a hard look at things. We were really fortunate to be here in Florida where we had all this migration and all this demand come in and opening up quickly and being able to get our properties up quicker. And so we saw that rent growth in both those sectors that we're active in, and that that propelled a lot of strength to the market there. So much that and I wish I could say we had a crystal ball, but we decided to sell a huge portion of our assets in 2021, and that closed in late 2021 and early 22, which is great. Now what do we do though? what do we do with our organizations, with our businesses, with our money? Where do we invest our equity? And we're having to have these hard conversations with land sellers right now, where we need extensions of time, we need more visibility. They're not discounting the prices yet, but there is going to be a correction in the land market too. There's going to be a correction in some of these costs and construction costs, or projects aren't going to get built because there's such a lack of visibility right now on what are our exit caps, on are these supply chain issues going to get resolved so the construction costs can either stabilize or decline. But we need that additional time to make projects work now. And, we're seeing some of the land sellers react to that positively and saying, we know you guys are in it for the long haul. We know Florida's going to continue to grow. There is demand from retailers and residents to come in and have new properties. The fundamentals are still super strong. In retail, vacancies are 5% and under in some markets here in Florida. So that's what we're basing on. We're trying to remain calm and get a little additional time to deal with what Graz is saying about not having that visibility for the next 3-6 months.
No, I can talk to a couple of the different points, but one of the things Jacob brought up about a lot of these deals being capitalized and financially engineered, it's really tough to do that right now on kind of commodity product because you're not going to get the leverage, and if you don't get the rent growth and your operating expenses are going up, you can't kind of get out of the rut of negative leverage because your cash flow isn't changing quick enough. What we did during COVID was, I think similar to what a lot of people did, was we looked at the operating businesses. How can I run this better? Do I need all these people? If the costs are going up, what industries or what assets can I be in where I can grow rent faster or I can grow revenue higher? So that kind of orients you more on the luxury or upscale side, because on some of the more commodity product, even though they did see great appreciation, right now it's really hard to justify charging 7% year-over-year growth, whereas if you have the net migration of a higher paid labor force, you can still kind of control some of the rent growth in better product. On the land side, what we see is a lot of entitlement costs to get from the start to the finish. So even though walking away from a deposit may not be the end of the world because the land is one of the smallest portions of the total capitalization of most of your development deals, the entitlement process and the time it took to get there, sometimes it still makes sense to close on the land, even at the original price, if they'll give you extensions to wait for your financing to come in, or they give you extensions to wait till you have all of the entitlements, as opposed to closing upon site plan approval. So there are some ways to financially engineer the deals, to get to the same place where the seller gets the same amount of money, but it's very valuable to you as the buyer to kind of time all of your carry accordingly so you don't drive up your basis. Hotels, continue to be a really large focus of ours because the price is reset daily, whereas in office, you're based on what you signed. So when your operating expenses keep going up, you can't control your revenues as well. Multifamily, you have a little bit more optionality, but you still have annual leases that you sign, and you can only get so much on renewals because you can only requalify people at X dollars as an increase because their pay is not going up the same as maybe someone new coming in. So it's been a really interesting process. I think we continue to look at our portfolio to make sure that we're running things as well as we can, because you're not necessarily getting better productivity from people that you're employing at higher rates. You're actually, I'd say, getting, in most cases, depending on the asset, worse quality labor at higher amounts and having to hire more people. There's a training issue, there's a redeployment issue where you just don't have the same sort of talent across the board in hospitality and in multifamily.
Agreed. I couldn't have said it better.
Excellent. So, one of the things I wanted to touch on next, which Casey, you just mentioned, was employment. So for the benefit of the employers here and also the FIU students who are going to be graduating and launching into the workforce, I do think as the economy is shifting, there are going to be more layoffs. We're hearing more and more about companies having layoffs every day. And I think it's just very interesting after COVID, there were so many changes in technology. Remote workforce was something that became a common term, working remotely, where some people did it before, but just it was a massive wave after COVID of people working remotely. And, it's interesting. I saw an economist recently, and he was talking about, would you rather launch into the job market at the peak of the market, or would you rather launch into the job market at the bottom of the market? And he was saying that he thinks it's better to, for students, for example, to start a job at the bottom of the market, maybe after a correction or after a crash, because the people who are still in that company are going to be the winners. They're going to be the survivors. They're going to be the strong ones. So you're going to be learning from the people who are really the best in that company and in their industry versus, people who are kind of flying, fast and loose, so to speak, at the top of the market where there's easy money floating around. So, we are heading into a different market. The employment market's going to look very different. And so I'm curious, for each of you, how is your, what is your hiring strategy, moving forward in the next 6-12 months? And how has it changed, in the past, say, 12 months? Graz, if we could start with you.
Sure. So, we entered 2020 very concerned, obviously, about what was going to happen in the economy, just like everybody else. Was the economy going to continue to roll? And, but at the time, we had a shortage of commercial real estate analysts going into 2020. Our basic strategy is we would rather build and train new folks than do lateral hires, because lateral appraisers that come from other firms tend to they bring their bad habits with them. There's a lot of retraining, and sometimes there's also a lot of resistance to really adopting new technologies and things like that. So our goal for our strategy with Integra was we can't buy new hires, right? We're competing with Cushman & Wakefield and CBRE and some private equity capitalized companies that are basically buying people, paying them signing bonuses, giving them, huge incentive packages. And so we looked at it and said, our strategy is to train them younger, train them better, and train them our way. That was our goal. And then we woke up in 2020 and said, well, we spent all this money on training infrastructure and thinking about this. What are we going to do? Now we don't really need to hire. And then we woke up 3 months later, we said, oh my gosh, we really need to hire. So we started aggressively hiring in 2020. We could not meet demand. In my business, in our business, the difficulty is that when there's a ton of demand, you have to have the trained workforce, but it takes a long time to learn how to do this job. Oftentimes 3 to 5 years to get good enough at it that I can put you in front of the client without a supervisor or without a senior with you. So it's a long training process for us. We have to acknowledge that. We just didn't have enough people. Obviously, the revenues of the company are driven by the number of people, just like lawyers, right? You have people that are billing every day. So our ability to grow really is tied to our ability to recruit and train. And so we just made bigger investments in that. And I'm hopeful that the company generally continues to execute on our recruiting strategy even as the economy changes, because it is such a long cycle to train. And the other thing, obviously, the benefit in the real estate appraisal world is that when times are good, we do well. And when times are bad, we do well. Mm-hmm. We do poorly in the middle. We do, because as things are slowing down, there's less work and the same amount of people. And so that point in time, right now, is difficult for us. But we actually are sort of a counter-cyclical business. So for those of you that maybe were thinking, hey, I want to go into the development business, I want to be a developer, or and you go out in the world and you don't find good opportunities out there, our business does very well in a down economy, because nobody knows what anything's worth. Right? They say, well, what is everything? And oftentimes they need a third-party opinion to help support an investment decision or a lending decision or whatever. So I would say our strategy is going to be recruit hard, train well, and be ready when the demand comes. Whether we go down or back up, we're going to be in demand, and so that's our strategy.
Great.
So for us, the hospitality industry lost 1 million jobs in the pandemic, and that's really hard to make up. Many hotels closed. Some still haven't opened. I know at one point, I think we only had 3 hotels that were open and everything was closed. So we're not even where we need to be from a hiring standpoint. I think we're probably around 80% of where we want to be. So we are hiring. I think most hospitality companies are hiring. I think we learned a big lesson during the pandemic where there were massive layoffs, and a lot of those people kind of got burned by the hospitality industry and decided, hey, I'm going to go work in real estate, or I'm going to go work for Amazon, and I kind of don't want to go back there because I'm afraid that it's going to happen again.
We saw that happen in the construction industry in the 80s, right? We had the crash in the 80s, and everybody in the construction industry that got burned, they couldn't come back. And when we got back to building, there was nobody in the construction industry, right? So.
And I think, obviously, the same thing happened in the airlines, is that they were having a really hard time bringing people back. So I think we'd like to think that we learned some lessons. And the good news for us is that the hospitality industry still has a way to go before full recovery. So, for us, in 2023 should still be a good year in the hospitality industry, so we continue to ramp up hiring.
So from our standpoint, housing and employment kind of, or, those two, they kind of move in lockstep, right? If you look at core CPI, so you strip out CPI of, energy pricing and food pricing, and you just look at what are the 2 biggest drivers of the core CPI right now, it's housing and it's payroll. Now, we're in the housing business, and so it kind of goes to my previous point, although the data is still showing on a trailing 12 basis growth in the housing cost and how that's contributing to CPI, it really is flattening out in the real world. But what I think continues to happen is that payrolls continue to rise, and there is definitely inflation in wages that people are receiving. Now, what we're seeing, which is interesting, is that more disproportionate amount of payroll growth happens at lower level jobs. So, you're starting from a lower base, so a $10,000 increase for somebody who makes $50,000 in terms of the percentages, it's much more significant than for somebody who makes $500,000. And, that's been happening across the board for us, whether it's our own employees and the management businesses of the buildings, or whether it's service providers that simply come and say, hey, I gotta push your pricing by 20% because I gotta pay my guy 20% more. Now, I don't necessarily think that is a problem, because I think, housing is leveling out, and, in many respects, wage growth, especially at the sort of lower level of the food chain, facilitates a lot of opportunity for the economy, right? People now have a little bit more money to spend on maybe eating in a restaurant, maybe discretionary spending. And you're also addressing, a spectrum or a compartment of your population that, in a way needs it more than maybe your middle class, upper class, where to the extent we have higher end buildings, people that earn more salaries, we don't really see any movement. People are doing great. So overall, it's definitely a dynamic, marketplace when it comes to hiring talent. Wages are definitely going up, and generally the value you get for your dollar is also less. I agree with the other comment made earlier that generally while wages go up, the quality of the talent is a little down, especially at the lower level of the food chain. But overall, I believe even that is going to start flattening out as the overall marketplace cools down, and we're seeing some fundamental changes as we speak.
But that's that point that you made, though, right? The unemployment nationally is sub 5%. Unemployment in Florida is 2.5%.
Right.
So when you talk about the quality of the workforce, it's just desperation. We're hiring people into jobs that we need those bodies to fill, but they're not necessarily the most qualified people. But that being said, don't worry, the Fed's going to break the economy, and that employment will slacken as we come forward.
But I think that's the point, right? So this morning data came out, and 260,000 jobs were added. Unemployment nationally is at 3.7%, so it went up a little bit. I think what we ought to really focus on is labor participation force versus just the unemployment. So, the unemployment rate is a function of how many jobs are being created in the economy, but it's also a function of actually how many people want to work. And what we're seeing as a result of COVID is that, labor participation went down, and that's a problem. And I think Fed, as they're looking at their, policies, one of the best news they could see is if labor participation would be actually increasing, because that would allow them maybe not to hike as aggressively, to cool down the labor market, because, even with adding new jobs and the economy growing, unemployment rate would effectively be either flat or ideally going up, because you would simply have more people coming back to work. And that's what we really need, and that's our problem, I think. And, just on that point also, I don't necessarily think inflation in wages for lower end workers, or that segment of the workforce, is bad, and that's where people.
Monica disagrees.
I disagree.
People. Well, obviously, from a standpoint of an employer, I don't like it, but I'm saying in terms of the global macro economy, as long as it's done the right way, the trickle down effect. Kind of, takes care of it in other places of the economy. And I'm thinking about it holistically. I'm not, if you were asking me as an investor, yes, I don't like it, of course. But from a macro standpoint, I think, it's something to think about as we move through the cycle, because inflation and anything else is bad, but, sometimes when wages grow, it actually helps the economy over time. That's my opinion.
I think what was said in the earlier panel about, Miami being a service driven, city and economy. I think what kind of keeps us up at night is, where are these people that we need in the hospitality industry that are making, $30,000 to $50,000 a year? Where are they going to live? Right? And also, that's not just at that level. Even trying to attract talent to move to certain key cities where the cost of living has gone up so much, it's difficult, right? We just had a candidate for a position at our Loews Miami Beach Hotel who's coming from Las Vegas. So, probably cost of living there is lower than Miami, but he had a hard time finding a great place to live here at a reasonable amount. So it does kind of impact the overall, I think, service economy, what's happening just in general with the housing market.
So it's interesting you say that, because we literally just had a meeting yesterday with one of the heads of, I don't remember the exact name, but it's a hospitality association for South Florida, and the biggest concern was exactly that. The point of the meeting was, you guys are in housing, how can we figure out a program for attainable or affordable housing that would actually fuel the ability of hospitality workers to come here and afford living. And so I think, we actually, one of our projects in Central Florida in Orlando has one of the largest component of affordable housing. It's about 700 units in a 6,000 unit development. And so I definitely agree that there is a need to create transformational projects that have that component of housing within the city of Miami or the county itself. The city of Miami did a great job with a program called Miami 21, where they push attainable housing in exchange for parking bonuses, height bonuses, density, incentives. But I think to the extent all the municipalities can do that, hopefully that would result in more either affordable or even attainable housing that has restricted rents and would facilitate more kind of opportunities, hiring opportunities for the hospitality industry. But definitely that's a hot topic. I couldn't agree more.
They're going to shut the mics off on the right side of the stage here, because we just won't shut up.
Hey, you guys.
But I'll just say one last thing, and I'm going to pass it back to the stage left. This is not just a Miami problem.
Right.
This is a nationwide problem.
I agree.
Back to the left stage,
I
Adam.
think the couch is winning.
That's it. We're winning. We're up.
To add on to what you're saying, a lot of what's happening in Miami as far as affordable housing, we're making some steps to remedy it. With the transportation-oriented projects that are happening up and down, the bonus density that the county's offering for residential developers in these projects. There is workforce housing components coming into these projects that is going to help a lot and hopefully solve some of the problems with hospitality workers. One thing to mention, so our company has an engineering company and has a construction company based in Naples. And you would think with the development business slowing down that there would be a slowdown, but now we get a hurricane comes, and all of a sudden these events create other dynamics here in our marketplace for employment that are extreme. We cannot find engineers, we can't find construction workers, and so these things happen here in Florida that are a little different than other parts of the country sometimes. The amount of billions of dollars of construction that is going to happen in Southwest Florida now is going to affect the market and the market for employment. So that's a challenge that we have, is finding engineers and qualified CAD operators, qualified contractors, project managers. There's going to be shifts in the economy and shifts from other areas of the country to come down here to South Florida to handle these issues.
So I think some of the employment issue is going to be resolved based on what people are willing to accept after some of this all kind of fades. For example, if you go to the grocery store now, there used to be people to help you, bag your groceries. That no longer exists. The wait time used to be maybe 1 or 2 people in a queue. Now maybe it's 5 to 7. What is the customer willing to accept to still pay a higher price at a certain store? And I think there's going to be an inflection point where, as a customer, you call someone that you hope to get service, and they can only take you 4 weeks from now because they only have one hairstylist, for example, or they only have one person that works there. So there's just, everywhere you see this lack of service, and you see this lack of wait time. You look at ordering on Uber Eats, and it's now more expensive than eating at the downstairs of a restaurant at a hotel. The cost of QSR delivered is more expensive than sometimes going to a mid-scale dining. So delivery used to be something that was obtainable to the masses. Now it's kind of shifting, and it's more on the upper end scale. You order a $15 sandwich on Uber Eats, it's $38 to $45 delivered.
Could you call my daughters and clue them in, please?
Yeah, these are not normal metrics. I mean, how much is someone willing to pay for a sandwich to get it delivered? There's all these inflection points going on right now, and I think it's going to be interesting to see how people pivot the business model to figure out what services they actually have to provide when they can employ people and which ones they don't. I hope, as a consumer, when I go to a hotel, there's still people available to help me, but it's obviously all moving digital. But part of traveling is getting an experience. And so on the luxury side, when you're spending $500-700 a night on a room, you still want that tangible experience. But even the luxury hotels can't hire people and train them and retain them and offer good service. And I think people's expectations are unfortunately, going down. To just expect the bare basics. I want someone to bring the right food to my table as opposed to ask me if I want any seasonings on top of it, or if they notice a fork was dropped, replace it. I think that unfortunately people's expectations have changed a lot. And as it relates to kind of graduating and looking for jobs, I challenge everybody, if the market of what you wanted to hire into isn't available, I would focus on trying to go into operations in an area that you eventually want to be on the principal side of. What I find is most people, especially at the junior level, don't understand the product. They don't understand the multifamily operation. They don't actually understand the hotel operation. So they're modeling projections in the future, and they're looking at growth rates, but they don't understand how many people it takes to run a front desk. They don't understand the value of a revenue manager. There's so many things that you could gain from actually working in the operation that will allow you to better, assist on the principal side in the future. And jobs and operations for talented, motivated people with follow through are always available.
Try hiring property managers now. It's one of the most difficult things to find. I know my friend Hugh Chen out there can vouch for that with their shopping center portfolio. He's always looking for property managers. It's just one of those operations is the thing that people don't realize, how important that talent is and how we have to grow it.
Excellent. So I will mention, since Rod just mentioned Hugh's name, Hugh Chen. He's with Saglo, sitting right here. They're actually managing a shopping center that I bought in Kendall. And as of last week, we're 100% occupied. So thank you, Hugh. So, and also I wanted to just, finish up the conversation about employment and the job market. For the students out there, one of the things that I think is very important is obviously pick something that you really enjoy. Try to figure out what you love. It's not easy, I understand. I did in my career, like I said, I started in accounting, ended up going into construction, and then ultimately brokerage. So it's okay to not know what you want when you're in college, but try to figure out, over time. You don't need to rush. But one thing I would recommend is to, find somebody that you can shadow. It's like an unpaid internship. You don't have to make a long-term commitment, but see if you can find somebody as a mentor. See if you can find somebody that you could spend a little bit of time with over the course of their day, maybe once a month. Because when you shadow somebody, it does turn into an internship, which oftentimes turns into a paid internship, which oftentimes turns into a job. And so it's always better. You're going to do better. You're going to make more money. You're going to have a better life if you can really work on getting into what you want instead of maybe chasing the money earlier on. So wanted to also kind of shift gears and touch on something that Monica, you just mentioned, is the employment for new hires. It's a big problem in Miami. It happened in the run-up of the market. In 2004, 5, and 6, it got so expensive. A lot of people were leaving Miami because they just couldn't afford the property taxes. They couldn't afford the payments. People were moving to the Carolinas. A lot of people moved back home because Miami is better. But right now that is a problem. People are having a very hard time finding housing, whether they can afford it or not. It almost is obviously it matters. But finding a place, something that's not too far from work, something that you could have a nice life. Personally, my wife and I were recently empty nesters. In the last 2 years, we personally visited 100 properties. We were looking at condos, and then we started looking at houses because we just couldn't find a condo. And we started thinking that what we wanted just didn't exist. So we looked at 100 places. We actually made 6 offers. We were under contract on 4 properties, and we just closed on one 2-3 weeks ago, which we're very happy about. We're going to have to do a complete gut rehab. It's in South Beach. It's a beautiful building. So we've got a project ahead of us, but it's not easy to find what you want. And so my question to all of you is, do you think that the construction that's taking place now, the development that's taking place now, do you think it's going to satisfy the needs? And are we going to overbuild like we did in past cycles? Why don't we start on this side? Casey, if you could start with that one.
Sure. So I think that there is a need for new product, but the market always works itself out. I mean, for those that are renting that don't like the product, you should hope people keep building as much as humanly possible, because then you'll get a new product that won't cost as much as an old product. So it kind of works itself out. I think that there's a lot of people moving to certain areas. For where I sit, I'd rather build a new product than buy something that's 1970s at a similar price. And where the cash flow is going and the cap rates, the discount to replacement metric just didn't make any sense. The floor plans were outdated. The amenities were, inconsistent with what people desire today. So I think people's needs have changed. The desire for new development that fits the lifestyle that people want today. Maybe it's less space in the unit, they pay more per square foot, but the amenities are strong and they can work from the common spaces or the clubhouses. They don't have a gym membership because the gym's nice at the new development. Depending on the market, the only way you could build was luxury. So I do think that there's a lot of luxury that's getting added to the cycle. It still seems to be pretty well received because a lot of people made money in this cycle and they still want to be moving, to nice product in these markets. But I think in some other areas of the country, there is going to be an inflection point. But at some point, it'll help then with the whole rental equilibrium, because it can't keep growing at the same rate it's been growing at. People's pays, aren't getting what they need to.
Yeah, I mean, we're seeing some pretty interesting projects here in Miami in particular. So we're working on a project called Central Plaza over by the airport, and it's on across from the Magic City Casino. And for instance, this kind of illustrates how you can unlock value here in Miami and provide affordable housing options for folks at a location that's close to employment centers. This is a 37-acre center that was old, dilapidated, 1959 vintage center with 300,000 square feet. And we're taking the back part of the shopping center and adding 1,000 apartment units in the back of the shopping center, but connecting it to the shopping center, bringing in new retailers, and creating a nice mixed-use environment. That's one example that Terra is involved in developing, but there's, between Palmetto Bay and Coconut Grove, there's probably 5,000 apartment units that are being delivered or under development right now. And these are not necessarily luxury. There's a wide range of values here and options for folks that will not have as much demand for using their cars and can affordably live on these transit nodes. There's another 1,700 units coming by Dolphin Mall at Upland Park, which is a public-private partnership that is being developed for high-speed bus from the West State area to downtown Miami. So that area around Beacon Lakes and Dolphin Mall and the west part of Doral is seeing some more affordable housing units. There's infill development happening in areas that you never would have thought of before, like the Westview Country Club up in North Miami, which has now been turned from a golf course into single-family homes at a $300,000 to $400,000 price point. So it's not only in South Dade where people talk about a lot of the growth here in Dade County. Developers are finding creative infill ways to meet a lot of the housing demands that we have in our market.
So from
Uh-oh, we're staged right now. Go, Jacob, keep it pointed.
No, I'll be quick. I think the biggest kind of data point from what I'm looking at is if you look at pre-COVID and also in the last cycle, so really pre-financial crisis, when you looked at the data in terms of multifamily housing in Miami, the market as a metro actually was not considered that big because a lot of your inventory that was really serving as a multifamily housing were condos, right? All the towers were built as condos. Latin American investors bought them up, and they were, pretty much sizing them to a 2 cap or a 3 cap, and then renting them out. I think the very much of a positive of, the last cycle and now even post-COVID is that the shadow condo inventory that's acting as multifamily is actually evaporating to a degree. People who buy condos actually live in them. They bring their incomes, they spend time down here. And on the other hand, I do agree that I think we have a ton of, real, solid, infill new housing in areas that are not necessarily in the city core, but they're interconnected very well to the employment centers by public transport, and the landscape of the housing is evolving, I think, down here in South Florida in a very nice and sensible way, but obviously we need more given the fundamentals.
I think it's very interesting. I mean, I'm a remote worker, right? But I got here 6 years ago, so I kind of missed the whole shift from the Northeast that happened the last couple of years. But obviously, that's driving a lot of prices up that I can see when I think of our team members and where, how they're going to find affordable housing. It's very encouraging to hear all of you say that there's not just luxury developments that are coming to Miami, because that's all you kind of hear about in the news, because most of our workforce cannot work remotely at our hotels. So I think the next big challenge will be transit, right? Because you still have to drive to the beach, as an example, to get to our hotel if you work there, and you have to park. So I think it's great. I think Miami's just an amazing, amazing city. Lots of people want to come visit, which is great for us, and lots of people still want to come here.
And not only transit, and the Metro Mover extension to Miami Beach will have
be
a great
amazing.
impact to address that. But as was said in the previous panel, schools, because I know like this project that we're working on at Central Plaza is going to have a charter school, a Matter Academy within it. When we think about these projects, they need to have educational components within them too to support this housing.
So we have about 5 minutes left for this
Right.
panel discussion. We're going to have lunch after that, but within the next 5 minutes, if we could just closing remarks, and Graz, I know we got to finish up what we were just touching on, and then maybe you could start with the closing remarks. Just, we've got maybe a minute each for everybody.
So my closing remarks, or I'm going to do closing remarks after I call barbecue sauce on this whole thing about affordable housing?
Yes.
Okay. So I have an economist friend of mine. He's from Mississippi, and when he wants to say that something is inaccurate, he calls it barbecue sauce as opposed to saying like bull or something. So I'd like to call barbecue sauce on this entire conversation about affordable housing on the following basis. $3 to $4 a square foot is not affordable. When you multiply that times 1,000 square feet, you're paying $4,000 for an apartment. So and you can't pencil out a new apartment deal at much less than 3, let alone in most markets, depending on land costs, 4. Now, that being said, creating new housing for people that can pay $3,000 to $4,000 a month or more to live in an apartment still helps reduce the other poor portions of the housing stock. But this idea that we can build new housing as affordable housing without subsidy is frankly barbecue sauce. The federal government has the best program in the world. It's called the LIHTC, Low Income Housing Tax Credit Program. That program is what's created the hundreds of thousands of units of affordable housing that are new. Now, I don't necessarily believe that affordable housing has to be all new, okay, because I am old. I appreciated Veronica's comment before about history. My grandfather would be disgusted that I spend $2,800 a year on cable, because that's not a basic need, right? And so we go back to like this idea of basic needs and affordable housing. Like if you're making, I had friends that graduated in the late 80s, early 90s, deep recession, 1989 to 1991. Many of you may have studied the savings and loan crisis. That's when I got into the world. And I didn't get to go live in a 1,000 square foot apartment by myself and have $2,800 a year worth of television. I lived with 5 other people in New York, and we split an apartment. 2 of us didn't even have a wall between the bedroom. So this idea that everybody's got to have 2,500 square feet in a backyard and a big pool, and it has to be affordable, frankly, is not practical in an urban area. New York spills out into New Jersey. That's how they get their affordable housing. Dallas spills out into all of the suburbs surrounding Dallas, including Fort Worth. That's how they get their affordable housing. Our problem is we don't have any place to spill. We spill in the Atlantic Ocean, we spill into the Keys that has a housing moratorium, or we spill into the Everglades, which is why Broward and Palm Beach County are where they are today. Thank you to Miami for pushing everybody into the quality of life that you could live in Broward County and be in a good school system and have a 4,000 square foot house for what it costs you to have a 1,500 square foot house in Miami. Transit also doesn't matter. The transit is extremely expensive to create, it's extremely expensive to maintain, and I love the concept that we have to improve our transit corridors. I completely agree, but that doesn't solve the affordable housing problem. So that's my take on it. That being said, it's a nationwide problem, and I think we need to continue to work on it. Closing thoughts, commercial real estate economy is changing. If you're in the employment market, and I see a lot of students in the room, which I really love, if you're in the employment market in the next 12 months, I totally agree with what Cassie says. Find a job, number 1. Number 2, don't accept it if it's remote. Go to work, meet people, make contacts, do everything you can to network. Number 3, don't really be sensitive about how much the job pays, because it's going to pay way more than what you're going to make by sitting on the couch waiting for the perfect job that's going to pay you the amount you think you're worth. Take the job, get the experience, meet people. That's my best advice to you. And by the way, that includes me, because I love to help people in the world. My best advice for a recessionary environment is help other people. Help other people. Help other people find a job, help other people get a deal, help other people network. And when you do that, your career will flourish, and you'll have a wonderful career, and you'll make a lot of friends.
I think that's great advice. Really is. So I'm not going to talk about affordable housing anymore. But,
Well, that was my closing.
But the hospitality industry is very strong, especially in Miami, certainly in Florida. We have jobs. If anybody's looking for jobs, we have loads of them. So please come and work with us. We're expecting an increase of 12% in demand this year, another 6% in demand in the Miami market. Our supply growth is muted, It's only around 2%. So while there's still more demand than supply, the hospitality industry will continue to do well here. So it's great news.
So all I would say is the time we're in right now in terms of entering the job market and kind of getting, some experience and so forth reminds me a little bit of kind of 2010, 2011, where it became clear that there was a problem in the economy and everything was resetting, but at the same time, people didn't really know where things were going to go. And so it was a little bit of a status quo for 18, 24, maybe 30 months. And at the time, I was extremely anxious as an acquisitions analyst. I kept underwriting all these deals and analyzing all this stuff, and I was getting very upset because all these deals that were brought to committee, we were like 20% off on pricing, and it was like, okay, so what am I doing? And I think now we might be at a similar point, and I think if you are a young professional entering our space, patience and kind of understanding of the context is very important. But sometimes those are periods of time where you can actually really advance yourself as a professional because you're not under the transactional pressure of the next big deal. You can fundamentally really get in a environment with other, seasoned folks and position yourself for success later on. So in many respects, although there's less opportunities now job-wise, it is an interesting time, and I would encourage all the students here to take advantage of that because it's going to help you very much down the path in your career.
So I just want to kind of close a little bit on retail and just kind of a summary of retail here. There was an ad campaign in Florida. The rules are different here, and the rules are a bit different in Miami. And why is retail so strong here? The density of population, the sales are off the charts here. I don't think there's other markets here in the United States other than New York and Los Angeles with this many $10 million plus sales restaurants as we have here. We've got major food groups. We've got Fox Restaurant. We got Star Restaurant. We got Cipriani. We got a lot of investment happening in the restaurant sector here that is driving a lot of this retail success in the market. We've got the grocery stores positioning and growing, Sprouts coming into our market, Trader Joe's expanding, Whole Foods expanding. So we have a lot of great dynamics. As we said, there's very little space. One of the reasons Metro is positioning to come here in Florida is because our retailers want to be in Florida. They see these sales, they see this growth, and they want to continue growing here. So even with these headwinds that we have, we're very bullish upon what's happening here in Miami and the fundamentals of the market here, and the need to continue to find great vehicles for these retailers to come in. Retail's not dead; it's just changing. If there's predictions that the mall space in the United States will drop probably by 50-60% over the next 10 years. Well, that retail sales goes somewhere else, and the open air centers and the mixed use centers that we're all involved in are going to be beneficiaries of those kind of shifts in the market. So it's great to be in Miami doing that kind of retail and seeing that kind of demand being fulfilled here in the market.
Yeah, I would just offer the words of advice that don't get caught up in the headlines. You'll see a lot of headlines and they like to grasp onto layoffs, recession when they have like the buzzwords. That doesn't mean everything is contracting. That just means certain things may be contracting. There's a lot of areas of growth, and you can kind of in your job search or as you're looking to do something, get yourself really anxious. But I think that there are a lot of firms that are going to capitalize on the disruption. This is how people make money, is when there's volatility and disruption. So I'm personally very excited about all of the interest rate hikes, and some things won't do as well as we hoped, but there'll be a lot of money to make on new deals that we're going to find because we're going to continue to work really hard and build in our team and grow and try to find new deals to do. One other area, I know I mentioned that operations are incredibly valuable if you don't know how the business is run, to get experience in. The other thing I'd say that there's a great opportunity in right now is working for the government. So if you're interested in doing real estate development or you're interested in doing construction, there's such a shortage in entitlement offices right now and people in the zoning department and the planning departments all across the country. The relationships you make with both land use attorneys, with developers, with people within the city is invaluable to any experience you'd have in the future. And so it may not seem intuitively like the most logical step. You know, people have positioned and pivoted, you know, phenomenally from taking an active role and really getting on the front line to see how these projects get done.
Excellent. So I'm just going to wrap up with my closing remarks. And I'm going to say that, in my opinion, the fundamentals of Miami and South Florida are very strong. I do think that prices are going to be considerably higher in 10 years from now. I think wages are going to be considerably higher in 10 years from now. I do think we're going to go through a little bit of a reset over the next 1 or 2, maybe 3 years. But I think we're going to get through it. And I think that Miami is going to continue to thrive. So, again, I wanted to thank everybody for being here and thank this panel. If everybody could join me in thanking the panel with a round of applause.
Adam.